Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we are looking at Apple.
If you find our talks useful, please consider subscribing, liking, and commenting underneath. It really helps us out.
So we have to address the elephant in the room right off the bat. Or maybe, given the market action yesterday, it's the bear in the room.
Yeah, the scene right now is messy, to put it mildly. Apple just took a massive 5% nosedive in a single trading session.
That is ugly.
We are talking about $200 billion in market cap just vanishing into thin air.
It is the worst single-day drop since April.
Exactly. And just to give that some context, losing $200 billion in a day is it's like losing the entire value of Disney or Netflix overnight.
Just gone.
Just gone. On the surface, it looks like a disaster. You see a number like that, and your instinct is to run for the hills. But that is why we are here, right? Is this actually the disaster it looks like?
Or is it capitulation? That is the real question. We're in the middle of this broader tech sell-off. Emotions are running incredibly high, and people are panic selling.
Right.
But our mission today is to see if the underlying data tells a completely different story than the ticker tape. Is the software sector meltdown overblown?
Let's unpack this. Because when you look at the actual earnings numbers, there's this weird disconnect. The stock drops 5%, but the report looks incredible.
It really is.
Like, I was reading through this morning and thinking, am I looking at the right company?
It really does feel like a disconnect. This is a classic case of sentiment fighting against fundamentals. The market is trading on fear, but the business is trading on performance.
Okay, so let's get into it. The hard numbers.
Let's do it. Fiscal Q1 2026. Total revenue came in at $143.8 billion.
Which is up 16% year over year. That is double-digit growth for a company of this size.
Exactly. And in the tech world, we get used to seeing small startups grow at 50% because they're starting from zero. But for a company of Apple's maturity, moving the needle by 16%.
That's like moving a mountain.
It really is. That is not easy to do.
And the star of the show, without a doubt, has to be the iPhone. Revenue there hit $85.27 billion, up 23.3%.
Huge numbers.
Okay, hold on, though. 23% growth on the iPhone. We have been hearing about this iPhone Supercycle for ages. Is that what this is?
That narrative just got busted?
Because for years, the story was the iPhone has peaked.
Right. Everyone keeps their phone for 4 years now.
Yeah.
But this is it. It confirms the supercycle theory is actually happening. It is not just hype anymore. The iPhone is making up nearly 60% of their net sales again. People are upgrading.
So what's driving it? Is it just that everyone's phone got old at the same time?
It's a mix. Yes, you have an aging installed base people with iPhone 13s and 14s who are finally ready to switch.
Yeah.
But it's also the preparation for on-device AI.
Ah, okay.
Consumers are realizing that if they want the new features coming down the pipe, the old hardware won't cut it. They need the new chips. So we are seeing a massive refresh cycle.
And it's not just selling phones, right? Because the narrative for a long time has been Apple is a services company now. The argument was always hardware will slow down, but they'll make it up by selling you iCloud and Apple Music.
And that engine is firing on all cylinders, too. It isn't one or the other anymore. It's both working in tandem. Services revenue hit a record $30.01 billion.
Wow.
That is up 14%.
14% is solid.
It is. But here's the number you really need to pay attention to.
Oh.
The gross margin on those services is 48.2%.
That is nearly 50% profit margin. That is the money printing machine.
Exactly.
Yeah.
That is the profit engine. Think about it. Hardware has costs. You have to buy metal, glass, chips, ship them across the ocean.
All right.
But services, once you build the infrastructure, the cost to add one more subscriber is, well, it's negligible. So we are seeing double-digit growth in advertising, music payments, cloud services.
So you have the hardware supercycle bringing people in and the high-margin services monetizing them.
It's the classic razor and blade model.
But the razor costs $1,000 and the blades are high-margin digital subscriptions.
Precisely. And that combination is what builds the floor under the stock price, regardless what the market does on a random Tuesday.
So the financials are rock solid. But here is the part that genuinely shocked me when I looked at the data. China.
Oh, the China turnaround is the biggest surprise in this report. By far.
For the last few years, the headline has basically been, China is weak, Apple is losing ground. We heard about nationalism, Huawei, the economy slowing down, and now.
Greater China revenue didn't just stabilize. It surged 38% to $25.3 billion.
38%. That is a massive recovery. That's not just a good quarter, that is a resurgence.
It is huge. And you look at market share. iPhone share in China has climbed back to 19% in early 2026. They are winning back the premium segment.
That feels significant because China was supposed to be the weak link. If that is fixed, the armor looks pretty tough. Why do you think that flipped so fast?
I think the Huawei threat was overstated. Yes, there is national pride, but at the end of the day, the Chinese consumer in the premium bracket wants the status symbol and the ecosystem integration that Apple offers. The local competitors are good, but they aren't Apple. And when the economy there started to find its footing again, the first thing people went back to was the premium brand.
And that brings us to the moat. We talk about moats a lot, what protects a business. With Apple, it is just scale, right?
It is scale, but it is also lock-in. The installed base is now over 2.5 billion devices.
2.5 billion. That is mind-boggling. That's like a third of the planet holding an Apple device.
It is. And think about the switching costs. This is the moat. It isn't just that the phone is nice. It's that once you have the device, you pay for the services. Your photos are in iCloud. Your messages are blue.
Right.
You subscribe to Apple Music.
Yeah.
To leave Apple, you have to undergo actual pain. You have to migrate your entire digital life.
Right. I mean, I can't imagine trying to move all my family photos and getting my parents to download a new chat app. It's just not happening.
Exactly. This is what protects them against Alphabet and Microsoft.
Yeah.
Even if competitors have great AI or a slightly better camera, if you are locked into the Apple ecosystem, you're probably going to use Apple's version of it.
Well, speaking of AI, that is the other big fear factor, right? Part of this sell-off is driven by the narrative that Apple is behind on AI, that they missed the boat. Are they?
That is the narrative, but the strategy tells a different story.
Yeah.
They aren't trying to build everything from scratch alone. They have this multi-year collaboration with Google Gemini for the foundation model.
So they are letting Google do the heavy lifting on the back end.
To an extent. And it is smart capital allocation. Building these foundation models, the brains that power AI, cost billions in compute and electricity. It's an arms race. Apple is saying, okay, Google, you're good at that. We will use your engine. But, and this is key, they wrap it in Apple Intelligence, which is now available in 15 languages.
And knowing Apple, they are probably spinning this as a privacy play.
Precisely. That is their wedge.
Right.
Their differentiation is on-device privacy and private cloud compute. They're saying, sure, use AI, but do it safely with us.
Private cloud compute. Can you break that down? It sounds like an oxymoron.
It's their solution to the privacy problem.
Right.
Usually, powerful AI requires sending your data to a massive server farm owned by Google or Microsoft. That's a privacy risk.
Right.
Apple built their own servers using Apple silicon chips. When your phone needs more power, it sends data to this private cloud. The key is the data is processed and then immediately deleted. It's never stored.
So they can verify that they can't even see it.
Exactly. It's cryptographically verifiable. They're betting that users care more about their personal data staying private than they care about having the absolute smartest chatbot.
Plus, we are looking at future tech like agentic AI and the upcoming Siri 2.0.
Agentic AI. I keep seeing this term. How is that different from just asking Siri to set a timer?
Current AI is a chatbot. You ask a question, it gives an answer. An agent does things. It takes action. So instead of asking Siri, what flights go to New York, you say, Siri, book me a flight to New York on Tuesday morning, use my credit card on file, and add it to my calendar. The AI acts as an agent on your behalf across different apps.
Okay, if they can actually pull that off, if they can finally make Siri useful in that way, that would be a game changer.
It is the next frontier. It transforms the phone from a consumption device into a personal concierge.
I have also heard some wild rumors about hardware to support this. Foldable iPhones, Vision Pro expansion.
There are always rumors. A foldable iPhone is the white whale of Apple rumors. We see patents, we hear supply chain whispers. It is possible as a future lever to pull. But right now, it's unconfirmed.
And the thesis doesn't even need it to work.
Exactly. The current standard iPhone lineup is doing the heavy lifting just fine.
Okay, so let's pause. We've established the fundamentals are strong, China is back, and there is a legitimate plan for AI. So, why the 5% drop? Why is the market freaking out? Let's confront the bear case.
Right. It can't all be sunshine and roses.
It is a combination of negative headlines that all hit at once. First, you have the regulatory pressure. The FTC is scrutinizing them regarding news bias.
Okay, the regulators are always lurking. That's standard operating procedure for big tech.
True, but it creates noise. Then you have the delays in the Siri upgrade. The market wanted Siri 2.0 yesterday. They wanted the agentic features now. Hearing it's coming in spring 2026 makes traders nervous.
Patience is in short supply.
Very short. And we can't ignore the political landscape. The DOJ shakeup with the new administration creates some uncertainty around M&A.
Mergers and acquisitions, right.
It does. If Apple wants to buy a startup to fix a hole in their tech, will the government let them? That is a valid concern. But you take a step back, a lot of this is just, it's noise.
How so? Give me an example of noise versus reality.
Take the patent lawsuit. Apple recently defended a massive 4G wireless patent lawsuit. In the past, they have lost huge amounts, like $806 million in similar cases. This time, they won.
And the market completely ignored that because they were too busy panicking about the drop.
Exactly. It is a win that preserves nearly $1 billion in cash and removes a legal headache, but it got buried in the red tape.
What about costs? I saw some notes about hardware getting more expensive to build.
That is the other bear argument. Analysts are worried about the rising costs of memory and vapor chambers for the new phones. It's a cooling technology. AI chips run hot, extremely hot. To keep the phone from overheating, you need advanced cooling systems, vapor chambers. Those are expensive.
So the fear is that these costs will eat into Apple's profit margins.
That's the fear. But remember that 48.2% margin on services.
Yeah.
And the Google collaboration. That cushions the blow. They have margin safety that other hardware companies just don't have. They can afford to spend a little more on cooling the phone because they make it back on the App Store fees.
So the bears are looking at the headlines and the component costs, and the bulls are looking at the balance sheet and the ecosystem. Let's talk valuation. Where is this ship heading for the rest of fiscal 2026?
If we look at the projections for the full fiscal year, we are looking at projected revenue of $461.12 billion, up almost 11%.
And earnings per share.
Expected to rise to $8.41. That is a 12.7% jump.
Those are healthy numbers. Double-digit growth for a mega cap is nothing to sneeze at. What are the analysts saying? Usually, when a stock drops like this, you see a flurry of downgrades.
Not here. That's the interesting signal. Look at Mark Newman from Bernstein. He actually raised his price target to $340.
$340. That is significant upside from here.
It's massive upside. He is citing Apple Intelligence as the driver, explicitly looking past the cost worries. And Morgan Stanley is forecasting 232 million iPhone shipments.
So despite the sell-off, the Supercycle narrative is keeping the big money interested.
Institutional flow, the pension funds, the hedge funds, is implied to be strong. They know a buying opportunity when they see one. They see retail investors panicking, and they see a discount window.
Okay, so let's translate this for the listener. If I am sitting here thinking maybe I should buy the dip, what should I be watching? What is on the catalyst calendar?
Immediate term. Today, February 13th, we have the CPI report.
The inflation number, that moves everything.
It does. If inflation comes in hot, tech might wobble again. But given the strength in U.S. jobs, we might see a rotation into quality. And Apple is the definition of quality defensive tech.
So a hot CPI might actually send people running to Apple as a safe haven, like digital gold.
It is very possible. When the market gets scary, people buy companies with huge cash piles. Apple has the biggest pile. Then, looking a bit further out, spring 2026. That is the launch window for Siri 2.0 and the agentic AI features.
That is the show me the product moment.
Exactly. If the demo is good, the stock flies. And then late April or early May, we get Q2 earnings. That will be the real test.
Did the iPhone momentum hold up after the holiday season?
That's the key. If Q2 shows sustained growth, the bear case is essentially dead.
All right, let's bring it all together. What is the verdict?
I am assigning a bullish score of 8 out of 10.
8 out of 10. That is pretty confident given the sea of red on the screen today. You're telling the listener to ignore the tape.
I'm telling them to look past the tape. The fundamentals just outweigh the noise. You have 23% iPhone growth. You have a $30 billion services business growing at 14%.
Right.
The near-term volatility from the FTC or Siri delays. It is frustrating, sure. It makes a chart look ugly for a week.
Yeah.
But it doesn't break the thesis.
So the elevator pitches, the dip is an overreaction.
The dip is an opportunity. This is a multi-year hold into the iPhone 18 cycle. Use these dips, like this 5% drop or any volatility from the CPI, as buying opportunities.
And the premium valuation is justified.
It's justified because you aren't just buying a phone maker. You're buying into a $2.5 billion device ecosystem that is monetizing better than ever.
It is hard to argue with 2.5 billion users. That's a country bigger than China and India combined, all paying rent to Apple.
It is.
You know, here's a thought to leave you with. We talk so much about who has the best AI model, Google, OpenAI, whoever. But if Apple is successfully leveraging Google's AI while maintaining its own privacy-first hardware lock-in, are they actually winning the AI war by letting others build the engines while they own the users?
That is the ultimate power move. Let them spend the capital to build the engine, you just charge the toll for the road.
Something to think about. Thanks for listening to Smart Wealth with Joshua.
See you next time.
Please remember, this is for informational purposes only. Do your own due diligence. Catch you in the next one.